I'm joining you today from the AllianzGI core fixed income team to discuss the latest thoughts on strategy and markets and how this has been reflected in our unconstrained global fixed income portfolios. My name is Luke Copley. I'm a product specialist for the Allianz core fixed income team. And in today's session, I'm focusing on our Allianz Global Opportunistic Bond strategy. Interestingly, the Fed Chair Powell recently cited Fed research which suggested that the spread between today's 3-month T-bill rate and 3-month rate 18 months forward was a better predictor of forthcoming recessions. This is in sharp contrast to the historic research that's been focused on curve spreads at longer tenors, such as the 2s 10s or the 5-year versus 30-year. That 3-month Treasury forward spread is currently trading around 2.5%, the steepest since records began. Clearly, the Fed's focus here highlights its near-term bias to get towards a neutral or even potentially restrictive policy stance in a hurry. As a result, we're looking to engage with curve flattening trades increasingly in our strategy, i.e. selling the front end of the curve and buying the back end. There is a question as to how much the market believes this Fed narrative, given some inversion elsewhere along the curve, for example in 5-year versus 10-year. We can see that the market is challenging the longer-term growth forecasts here and the scope for growth to soften in future, albeit perhaps not into recession territory. Given the moves wider in spreads earlier this year, there are some good pockets of value opening up across sectors. We've had a really defensive credit footprint in portfolios for some time now. In fact, it's been the lowest level of credit risk in our strategy versus any time over the last 10 years. So there's plenty of room for us to increase credit allocations. So as a result, we have recently started to selectively add back credit risk, taking advantage of wider spreads and looking at targets across EM sovereign spreads, investment grade corporates and higher quality high yield. The last 4 hiking cycles have shown that the US dollar tends to weaken in the 3 to 6 month period following the first Fed hike. So there's precedent here for dollar weakness ahead. However, we also recognise that there are differentiators between this cycle versus others. The Fed is certainly playing catch up, inflation remains very sticky globally, so there is pressure in the near term for higher front-end treasury yields, and this can be supportive for the dollar. We've recently added 3 currency positions in portfolios versus US dollar, increasing the share of portfolio risk in our active FX strategies.